XRP's connection to major market makers is becoming harder to ignore. Recent news confirms that the largest market maker in the United States, Citadel Securities, has become a direct investor in Ripple, the company with XRP at the center of its business model. When you combine that with what one of Ripple's earliest employees, Bob Wei, explained years ago about how market makers could use XRP, a very clear picture starts to form. This video connects those two elements: an old technical insight from inside Ripple and a new concrete move from one of the most powerful liquidity providers in US markets. Taken together, they point toward XRP becoming a function of markets, not just a speculative asset. So, who is Bob Wei, and why does what he said matter? Bob Wei was one of Ripple's first 10 employees. Before joining Ripple, he worked at Lincoln Corp in the mid-1990s, where his project, Intelligent Computer-Aided Training, received NASA's 1995 Software Technology of the Year award. He also did subcontracting work for NASA and has a long history as a software engineer across multiple companies. He joined Ripple in 2013 and stayed until 2018, working across different roles and gaining a deep understanding of how the system was designed to operate. In one of his reflections about joining Ripple, he paraphrased a recurring internal conversation. The idea was simple but powerful. If Ripple captured even a small fraction of the international payments market, what value would XRP need to reach in order to support that volume? He described the numbers as really, really big trade numbers, adding that with a total supply of 100 billion XRP, the implied valuation was enough to make him say, wow. Those conversations both excited him and made him anxious because his job was to help make sure Ripple did not mess it all up. In other words, from very early on, people inside Ripple understood that if XRP truly became embedded in global payments, its valuation would have to grow to support the scale of flows. In a rare interview, Bob Wei also explained how XRP was designed to behave more like digital cash that anyone, anywhere could hold and transfer. He compared it to paper money. If someone hands you a physical banknote, you don't fill out forms or ask permission. You simply take it. His point was that XRP, as a bearer asset, could circulate globally without complex onboarding for every transfer, as long as users and institutions were willing to accept it. From there, he emphasized the importance of network size and liquidity. The larger the community of people and institutions willing to accept XRP, the more liquid and valuable it becomes. Ripple's goal, as he explained it, was simple but ambitious. Build a system where anyone in the world can hold and send XRP. Even if the recipient doesn't want XRP directly, the system can convert it seamlessly into their preferred currency, for example, Chinese yuan, behind the scenes. The sender spends XRP, the recipient receives local currency, and the conversion happens through XRP as a bridge. The vision is a global system for money, where XRP is the neutral settlement layer. That brings us to the more technical part of his thinking. How do market makers actually use XRP, and how does that impact price and liquidity? Most people in crypto are familiar with speculators, but not with market makers. Bob Wei drew a sharp line between these two profiles. A speculator will tell you that the way to drive up XRP's price is simple. Increase the number of people who buy and hold XRP long term. More buying volume without equivalent selling pressure forces the market to consume the lowest price sell orders first, and then move up the order book to higher and higher prices. A market maker, however, behaves very differently. On the surface, they do not look like long-term holders because they are constantly placing both buy and sell orders. To a casual observer, that doesn't look like hodling at all, but that view is incomplete. To place a sell order, a market maker must first own the XRP they are selling. If a market maker wants to be present in the market continuously, placing sell orders at all times, then they must continuously hold an inventory of XRP. That means they are always buying back the XRP they sell as soon as possible so they can sell again on the next payment or trade. Bob Wei describes a simple example. Imagine an XRP USD market maker who allocates half of their capital to XRP and half to USD. Their goal is to keep that value balanced over time and to grow their total investment through spread profits. Their profit comes from the difference between the highest bid and the lowest offer, the spread. They are always trying to sell XRP slightly higher than they buy it back. Crucially, their profits scale with payment volume, not just with XRP's price change. The more payments move through XRP as a bridge, the more opportunities they have to earn on each transaction. If trading is profitable on a given corridor, for example, XRP versus USD, the market maker wants to keep trading that corridor indefinitely. To do so, they must keep holding XRP indefinitely. That is the core point. Profitable market makers have a built-in incentive to remain long XRP over time. According to Bob Wei, if you want to increase XRP's price structurally, you don't only seek more speculators. You attract more market makers to each corridor. Each new market maker must first purchase a stake of XRP to participate. Once they own that stake and are profitably making markets, they effectively become long-term holders because their business model depends on continuously having XRP inventory. He also points out that a market maker's profit does not scale simply with the size of their investment, but with the volume of payments moving through their corridor. Doubling payment volume can support twice as many market makers at the same return on investment. But that also means the total amount of XRP held by market makers must increase as more of them join and as volume grows. In a long thread, Bob Wei goes even deeper into this logic with a concrete example. He introduces a market maker named Mark, who wants to operate in the XRP USD corridor. Mark has $200,000 of capital and wants to provide liquidity. He deposits the full amount to an XRP-enabled exchange. At that point, he has $200,000 and 0 XRP, not very useful for his business, because he needs both sides of the market. So Mark buys $100,000 worth of XRP. Now he has $100,000 in cash and $100,000 worth of XRP. From there, he can place sell orders to convert XRP to dollars and buy orders to convert dollars back into XRP. He sets his sell prices slightly above his buy prices. That spread is his profit. As Mark buys into XRP initially, his demand puts upward pressure on price. The more market makers like Mark you attract, the more initial buying demand you create. That cumulative buy-in adds structural upward pressure on XRP's price. Bob then imagines two scenarios after Mark has been trading for some time, assuming XRP's price didn't change during the period. Mark might end up with $100,000 in cash and 300,000 XRP, or $133,333 in cash and 200,000 XRP, both representing a 16.6% return on his original $200,000 capital in different balances. If XRP's price does increase, the scenario where Mark ends up with more XRP is even more attractive, giving him an incentive to maintain a strong XRP inventory. Mark still has real-world expenses, rent, utilities, and so on, so he will periodically convert some profit into cash. But as long as his core XRP inventory remains intact, his selling activity does not create the same kind of downward pressure as a one-time speculator exit. His initial purchase of XRP pushed the price up. His later profit withdrawals primarily come from surplus dollars, not from dumping his entire XRP stake. Bob also highlights another crucial point. In thin liquidity markets, a large speculator trying to sell an entire stack at once will push the price down significantly. Their perceived net worth, based on the current last traded price, is often overstated because the order book cannot absorb their selling without major slippage. However, as market makers add liquidity to support growing payment volumes, this problem diminishes. The same large holder can exit more smoothly because deeper liquidity moderates the downward price impact. So market makers not only benefit from volume, they also make large holdings more real in terms of realizable value. He then explores incentives further. Suppose a market maker can earn $1 on a $1,000 fiat-to-fiat payment path, but only 96 cents on the same payment routed through XRP. Naturally, they prefer the more profitable direct fiat path, which does nothing for XRP demand. However, imagine the system offers an extra 5 cents to market makers if they handle the payment via the XRP bridge instead. Now they earn $1 and 1 cent on the XRP path versus $1 on the fiat-only path. The payment is now routed through XRP, and the extra cost, 5 cents, buys meaningful XRP utility and volume that otherwise would not exist. On top of that, market makers who stay only on fiat-to-fiat paths lose business to those using XRP. Eventually, to remain competitive, they have to buy their own XRP and join the bridge path, again putting upward pressure on XRP's price. All of this came from Bob Wei's analysis back in 2019, a former early Ripple employee, NASA-recognized technologist, and someone deeply familiar with how XRP was meant to function in real corridors and real markets. Fast forward to the present. Ripple announced at Swell 2025 that it closed a $500 million strategic investment round at a $40 billion valuation, led by Fortress Investment Group and Citadel Securities. Citadel Securities is not a marginal player. It is often described as the largest and most influential market maker in the United States. It handles around 40% of all U.S. retail equity trading volume, acts as a major liquidity provider across equities, options, U.S. Treasuries, and FX, and trades trillions of dollars annually. It is also one of the biggest high-frequency trading firms in the world and a major market maker in ETFs. So now there is a direct documented link. Years ago, an early Ripple insider explained why market makers would eventually need to hold XRP and how their participation could drive liquidity and price. Today, one of the largest market makers in the world is a direct investor in Ripple, whose core technology stack and business model are built around XRP and the XRP ledger. That doesn't prove any specific future outcome, but it is a strong signal that serious players are positioning themselves around this ecosystem. Ripple continues to talk about building an internet of value, an infrastructure where value moves as easily as information does on the traditional internet. The internet itself runs on protocols like TCP/IP that are called trillions of times per day, largely invisible to the end user, but absolutely essential to everything that happens online. The thesis is that XRP and the XRP ledger could play a similar foundational role for value transfer, invisible to most people, but central to the functioning of digital finance. If XRP truly becomes a function of markets, embedded in payment corridors, used by market makers, and integrated into institutional infrastructure, then its role shifts from speculative asset to core liquidity layer. In that scenario, valuation is not driven only by narrative, but by the volume of global trade and settlement that the network is required to absorb. There is a lot of noise, speculation, and extreme claims around XRP, and it's important to filter that out. The more interesting story is this: how XRP was originally designed, who worked on it in the early days, how market makers are expected to interact with it, and which institutions are now aligning themselves with Ripple and the XRP ecosystem. When you connect Bob Wei's early technical explanations with Citadel Securities' recent direct investment in Ripple, you see at least part of that long-term design starting to move into reality. This is not a guarantee of any specific price or outcome, but it is a clear indicator that major market infrastructure players are taking XRP's role seriously. Each of them is making their own calculations about future liquidity, incentives, and market structure. As always, each viewer needs to reach their own conclusions. This analysis is not professional or financial advice. Consult a qualified expert before making investment decisions.